What is the bond market's role in financial crises? Imagine a world where the flow of money suddenly slows down or even stops. That's what can happen during a financial crisis, and the bond market plays a big part in this story. The bond market is where governments, companies, and other organizations sell debt to raise funds. Investors buy these bonds, lending their money in exchange for interest payments and the promise to get their money back later. These bonds come in different types, with government bonds usually seen as safer than corporate bonds. During a financial crisis, the bond market can become very shaky. Liquidity, which is how easily bonds can be bought or sold without changing their price, can dry up fast. When investors see trouble ahead, they often sell bonds quickly, especially those they think are risky. This rush to sell causes bond prices to fall sharply and yields or interest rates to rise. Higher yields mean it costs more for governments and companies to borrow money. This can make it harder for them to pay off existing debt or fund new projects. Take the COVID-19 pandemic as an example. In early 2020, the corporate bond market faced heavy selling. Investors pulled out large amounts of money from bond mutual funds, and dealers struggled to keep up with transactions. This created a liquidity crunch, making it difficult for companies to get funding. To help, the Federal Reserve stepped in and bought corporate bonds, acting like a market maker of last resort. This move helped restore some stability and kept the flow of money going to businesses that needed it. Government bonds, especially those from the United States, are key to the global financial system. They set the benchmark for interest rates and are considered very safe and easy to trade. But even these can face stress during a crisis. In March 2020, investors rushed to convert their bonds into cash, causing a liquidity crunch in the Treasury market. This showed that even the safest bonds can be affected during turbulent times. The bond market also influences how governments handle their finances during a crisis. When investor confidence drops, bond yields go up, making it more expensive for governments to borrow. This can push them to change their policies, like cutting spending or raising taxes, to keep market confidence. Historically, bond market reactions have led to big policy shifts aimed at keeping the economy stable. For adults planning their investments, understanding these bond market movements is important. Diversifying bonds with different credit qualities and maturities can help manage risk. Focusing on high-quality bonds often offers better resilience during tough times. Watching how bond prices and yields change helps avoid panic selling and spot good buying opportunities. Also, keeping an eye on central bank actions can give clues about market stability. In the end, the bond market is a vital part of the financial system. It provides funding for governments and companies but can also spread stress during crises through liquidity problems and rising borrowing costs. Knowing how it works helps investors make smarter choices and stay prepared for turbulent times.